In this lecture, we're going to look at share capital and distributable profits. So again, you would have looked at share capital, ordinary share capital in terms of AF1. What we're trying to move on to now is look at what are the different types of share capital that come in an organization, and particularly the characteristics, how do they differ from each other, and of course in the accounting requirements. So what's the difference between ordinary share capital and preference share capital? We'll then start to look at briefly just some of the company law requirements, which we will be covering in other modules around company law, particularly around distributable profits, i.e. what can be given back to shareholders. So you can't distribute every single element of an equity because there's some certain rules in company law that you don't distribute too much, which doesn't leave enough money in the business to pay off its creditors. So there's a certain limit there to protect the creditor's interests, and we look at what that limit is and how it's quantified. So share capital itself is money raised by issuing shares. Now, there's different classes of share capital, and the main classes we look at are ordinary share capital and preference share capital. And the main distinguishing characteristics you would have are on the voting rights, because ordinary shareholders, they have the voting rights, whereas preference shareholders, they usually don't have any voting rights in major decisions. Dividend rights, where ordinary shareholders usually don't have a guaranteed right to a dividend. Dividends are announced every year depending on how profitable the company is. So they're at the discretion of the board, whereas oftentimes preference shareholders have a mandatory right to a fixed dividend every year. And the final thing is capital rights in the event of liquidation is the ordinary shareholders are the last to get the money back. Preference shareholders, hence the name, they get the money back in preference to ordinary shareholders. So your authorised share capital, if you ever hear it, that's the maximum number of shares that can be issued, and that's going to be in company law. So the documents like the company's constitution, we would call the Memorandum and Articles of Association, but that has to be disclosed as well on the Statement of Financial Position. So you're not necessarily saying that's not the amount of shares that are issued, that's the maximum that can be issued. You will then have issued share capital, which has to be at a minimum lower or equal to authorised, because issued can't be above authorised. And that again will be disclosed in the Statement of Financial Position, and the issue shared capital is the one that you will see in your trial balance. That's the actual amount of shares that have been sold and money brought in for them. Right, so that's kind of relatively straightforward. Ordinary share capital, we know they have voting rights, we know they're the last to get money back, so they take on the biggest risk, and they're not guaranteed dividends, because dividends are only paid once at the discretion of the directors, which usually means when the company is doing well, you get a dividend, but in a recession, dividends are cut or they're stopped completely. So that's your first one, is your ordinary or equity shares. But then there is this thing called preference shares, and this was the key thing you want to get across here, the message is, there's no such thing as a standard preference share. A preference share could be a load of different characteristics: cumulative, redeemable, participating, and convertible. And we've talked to you about each of those. And in reality, it depends on the transaction, and it depends on what the people who are providing the money want. What type of protection, what type of financial instrument do they want? So you just have to have an appreciation of how different each preference share can be. There's no one size fits all, whereas ordinary shares, they're typically standard across the board. So your ordinary shares then, they're the first element. They're the owners of the business, they have voting rights. Profits may pay out to ordinary shareholders and dividends, but dividends are not guaranteed. And on liquidation, any cash remaining after everyone is paid off is given to investors. So they're the main risk takers. They get all the rewards if things go well, but they lose all their money first if a company goes bad. And their money, remember here, ordinary shares are not redeemable. So what we mean by that is, like a loan, the bank gets their money back from a loan within 5 or 10 years, depending on the length of the loan. That's not for ordinary shareholders. The only way the ordinary shareholders are getting their money back is if they sell on their shares to someone else. Preference shares, they're often known as a hybrid. So they're a mix of debt and equity, depending on the characteristics they take. And that creates a bit of an accounting problem in terms of how we account for it. So they're often called mezzanine finance. If you think of the mezzanine floor, you have a ground floor, a first floor, and mezzanine is somewhere halfway through. So it's kind of some characteristics of debt, some characteristics of equity. Sometimes they'll be entitled to a fixed dividend. And the phrase preference means they get it in preference to ordinary dividend. So any preference share dividend will be paid before ordinary dividend. So they take on less risk in the capital structure of a business. And on liquidation, they are entitled to be repaid their amount of their shares, but they usually don't carry voting rights. So unlike the ordinary shareholders who are the actual owners of the business and can vote at the AGM, preference shareholders typically do not. But there are, as we said, many flavours here, and it's usually the management or the capital providers will dictate what they want. So what are the characteristics they want? And remember, differing characteristics now will mean different accounting. So that's the kind of thing we'll want to look at it just at a high level here to understand the importance of how to classify these shares. So you could have cumulative preference shares. What this means is, in 1 year, if you don't have enough profit to pay preference dividend, you have to pay double the dividend next year. So it accumulates up until it's paid. So that means you don't lose out on dividends. Like in 1 year, if ordinary dividends aren't paid, they're gone. They're lost completely. You start afresh from next year. Whereas if you have something called a cumulative preference share, if you lose out on the dividends 1 year, well, the next profitable year you have to get double the dividends because it accumulates up until you get your money. So that's a slightly different one. That's more like a bank loan where you have to pay your amount. Otherwise, you're going to have to pay it the next time and it accumulates up based on interest. You could have redeemable preference shares. These are preference shares that have a finite life. So they're very similar to a loan. You might have a 5-year redeemable preference share, which means you have to redeem them in 5 years, i.e. pay the money back to whoever gave you the money in the first place. So that means it's more like a loan rather than ordinary shares, which are non-redeemable. You could also have participating preference shares, which means the shareholders get a fixed dividend, but they also are entitled to a future share of profits with ordinary shareholders. So by saying participating, we mean they participate in the profits. So they act very like ordinary shareholders then. And then you can also have convertible preference shares, which means these preference shares can convert into ordinary shares at some agreed terms in the future. So you have kind of a best of both worlds there. You can leave it as a preference share if you want, but if certain things happen and you think, oh, I wouldn't mind having ordinary shares now, you can convert at particular agreed terms. So that's not unusual as well. But you could have a cumulative preference share that's convertible. You could have a redeemable and participating preference share. So they're not mutually exclusive. And that will really depend, very importantly in the real world, you have to read the legal documents. What are the characteristics of this preference share? The key message you want to take away from AC220 is there's no one size fits all. And from an accounting perspective, that creates a bit of a problem. Because we have to figure out then, well, if I get 100 million in preference shares, should I put that in the equity section of my statement of financial position? Or should I put it as a debt in the liability section? And that's important because the users of financial statements want to know, is this debt or equity? Because that will impact your key ratios. Your gearing ratio, whether the preference dividend, if it's equity, will be treated as a normal dividend. Whereas if preference shares are treated as debt, technically your preference dividend should be treated as a finance cost, which will impact your interest cover. So there is important aspects. Now we're only touching at a high level here. You will look at this in a lot more detail in AF3 when we look at IS32 and financial instruments. But in terms of an equity instrument, the key thing here is a residual interest. What that means is you have the remaining interest after everyone else has been paid. So it's a residual interest, which is typical of ordinary shareholders. They have the residual interest once all other liabilities are paid off. Whereas a critical feature of a financial liability, a debt instrument, is importantly underlined the contractual obligation to deliver cash or another financial asset. So essentially saying here, when you see a contractual obligation to pay the money back in terms of a redeemable preference share or a mandatory dividend to be paid every year, that's more likely going to be a debt instrument. So it's going to be a financial liability. When you see preference shares that are not redeemable, and you see a preference share that doesn't have a mandatory dividend, it's at the discretion of the company, that's more likely an equity instrument because it's based on what's residual, whatever's left over. There's no mandatory element to pay any cash. Now there is a bit more complex one where you can have a combination of debt and equity. These are known as compound instruments. But again, they're beyond the scope of AF2. You'll cover them in AF3 and onto the masters if you go on that far as well. But for your perspective, just have an appreciation, IS32 deals with presentation. And that's quite an important aspect in terms of reflecting the true substance on the statement of financial position. So take, for example, these three different scenarios where Plastic PLC has issued 100,000 preference shares, and you're asked to journal entries for the following three scenarios. So the first thing here, the preference shares are redeemable in 2 years and they're fixed dividends. You have a mandatory dividend and they're redeemable in 2 years. So clearly there you have contractual cash flows. You have a contractual obligations you send here to pay. That means your preference shares here are treated as debt. Because they are a debt instrument, although they're preference shares, the classification under IAS 32 would mean they're debt. So for one, the debit and credit would be, if we just look at it here, for one, it will be debit bank, get the money in, credit, non-current liabilities. So it'll be debt instrument, and that will be 100,000, 100,000. Let me just do there. Tidy that up, and just be careful, then you'll debit finance costs and you'll credit bank the 10% dividend, which is 1,000 or 10,000. So that's an important aspect to watch for, is if you treat it as debt, non-current liabilities, the dividend that's paid every year is actually finance cost. It's the equivalent to interest. You're saying this is the equivalent to getting a loan, albeit it's called preference shares. For note 2, the preference shares are irredeemable, so you actually don't have to pay it back in 2 years or whatever year's time, but you have a fixed dividend. So these are non-redeemable, but they do have a mandatory dividend. So you have a bit of a grayer area here, but in the standard IAS 32, they say there's still a contractual cash flow to pay dividends every year. That makes it more like debt than equity, so you have the exact same entries for scenario 2. Although it's a bit grayer, because the shares are irredeemable, the fact that you have a fixed dividend every year means this is a financial liability, it is debt. And you put that in your liability section and you treat your dividend, which is inverted commas, is actually going to be treated as finance costs. The last one is different in the case that the preference shares are irredeemable and the dividends are at the discretion of Plastic. So in that case, this is going to be treated as an equity, because you don't have to pay back the shares and the dividends are at the discretion of Plastic, meaning it's the residual. If you have enough money left over in Plastic, you will pay a dividend. If not, you won't. So for 3, it's going to be debit bank, but it's going to be credit preference share capital, and that will be in the equity section. 100,000, 100,000, and then you're going to debit dividends, credit bank. The dividends, they will be in the statement of change in equity, which is 5,000, if they're paid. If they're not paid, there'll be no entry. So that's the key thing we want to get your head around there, is the classification. If it has a contractual obligation to pay money, it's a financial liability. It'll be treated as a liability and the payment will be treated as finance costs. If there's no contractual obligation to pay money, then it's an equity instrument and it'll go through the equity section of the statement of financial position. So that's as much as we cover in that aspect in AF2. I said we'll cover a bit more when we get on to AF3 next year. So there are your main ones. You have authorized share capital is the maximum number of shares. Issued is the number of shares that have been issued. And these two are more specific. This is the portion of issued share capital which the company is requested to pay. So you might say we've issued more shares and we're expecting shareholders to pay the money up. So it might take a couple of weeks for the company's shareholders to pay the money in. And this is the amount of share capital that's actually paid in. So again, these two are quite niche. You usually won't see these in the financial statements. It's these two are the main ones that you want to focus on. That's the most shares they can issue, and that's the current amount of shares that they've issued. That's the one you'll see in the trial balance, issued share capital. So brief recap then on how do you record the journals for issue of shares. Again, shouldn't cause students much hassle. In this case, you've issued 100,000 shares, €1 ordinary shares, that's their nominal value or their par value, and you issue them at their par value. So the debit and credit for that will be debit bank and credit ordinary share capital. Nothing more than that, and it'll be 100,000. The only amount that goes into ordinary share capital is the nominal amount. And we said here we didn't issue the shares at a premium. So they all go to ordinary share capital. Now that shouldn't cause any student any trouble. So we can then look at an example which looks at an issue of shares at a premium. So instead of issuing them at €1, you issue them at €1.20. So we know the share premium element goes to a separate account. Debit bank, 120. Credit ordinary share capital, the nominal amount, which is 100,000. And then you have a new share premium account, which takes the premium, which is the 20 cent over and above, which is 20,000. So nothing more complicated than that. And you'll have a separate line item in the equity section for share premium and a separate column in the statement of changes in equity for share premium as well. So when you issue shares at a premium above the nominal value, that's the value is the legal shares, the legal value of the shares per the documents. Usually that's no resemblance to the commercial value of the shares, but that's how it will be recorded. And your share premium then is disclosed separately, and that is not distributable. So you can't distribute your share premium like you distribute dividends from retained earnings, but it can be used for preliminary expenses setting up the business, commission paid on the issue of shares, or discount on the issue of debentures. So you can use it for certain things, but the share premium cannot be distributed to shareholders like retained earnings. And we'll see that in the next section in this recording. You can do a bonus issue, which is also called a scrip or a capitalization issue, where essentially you don't give shareholders cash, you give them shares instead as a dividend. Often they're used to restructure an entity's equity, or they can be used to increase the number of shares. Now, one reason you might do that is you want to reduce the share price. Because if you have a very high share price, you could have a share price of 100 or 200 euro because you have a very low number of shares. Well, the overall business value doesn't change. But if you double the number of shares, for example, the value of each share halves. So it just makes it more liquid, that more people may want to buy shares worth 50 euro than shares worth 100, being able to diversify their risk, etc. So it's a small thing. It doesn't change the overall value of the business, but it does change the value of the shares which you're able to buy. So it can make them more attractive to retail investors because they might want to buy shares, smaller number of shares at a smaller price. So for example, the bonus issue here will come out of share premium. What will happen is they make a bonus issue of 1 new share for every 10 shares held. So here you have 800,000. We're assuming it's €1 shares. So we have 800,000 shares. So you're going to issue 80,000 new shares. So 1 for 10. So for 800,000, you divide by 10, which gets you 80. And the debit and credit there would be debit share premium, credit ordinary share capital. Right? So it's a key thing that you understand. You debit your share premium, you credit your ordinary share capital, and that will be 80,000. And here, 80,000. So all you're doing is converting your share premium into ordinary share capital. If you didn't have enough in share premium, the rest will come out of retained earnings. So it just depends how much you want to issue. But if you think about it, so the shareholders are getting no cash, they're just getting extra shares. So the overall business doesn't change, but the value of each share will change now because there's more shares owning the business. Another important issue you could have is a rights issue. This is where you give existing shareholders the right to buy new shares for a discount. So you give them a right to encourage shareholders to buy more shares, where you're trying to raise more equity finance, but you have the choice. You don't have to. So a shareholder might say, I don't want to, you exercise those rights and buy it, but you can sell your rights then to other people who may want to buy your shares. So the rights issue is given to existing shareholders. So in this case here, a company's made a rights issue. They've said you have a right issue is 1 new share for every 10 owned, which is similar to what we had before. The nominal value is €1, but watch this, the right exercise price is 150. So what they're saying is, we will give you new shares, but you have to pay money for them. So you are getting a rights issue where you're allowed to buy the shares at a discount. So instead of buying them at their market value of €2, you're allowed to buy them at 150. And the reason they do that is to make it attractive to shareholders to actually engage in the rights issue. Because otherwise they could just buy the €2 shares in the market. They'd have no reason to engage in the rights issue. So the discount from about 50 cents is to make it attractive. And the rights issue was 75% subscribed. So think about that now. The rights given was 1 new share for every 10 owned, which means the total rights was 80,000 shares. If 75% was subscribed, that means only 60,000 new shares are subscribed. So think about the debits and credits here. 65, or 60,000 should I say, so I'll put it here. 80,000 times 75% equals 60,000 new shares. Shareholders pay 60,000 times 1.5, they pay 90,000 euro. That's the first key thing. And so they pay the 150. The nominal value is 1, the market value is 2 euro. So that's what we call the commercial market value. So you're told here they're issued for 150. So that means your debits and credits are, you're going to get 90,000 in. Debit bank, 90,000. You credit ordinary share capital, 60,000, which is 60,000 shares times 1. You credit share premium, 30,000. You notice here the 2 euro doesn't have any impact because they were never issued for 2 euro. They were only issued for 150. So that means that will be the entries. You're going to get 150 times 60,000 shares. You are going to credit ordinary share capital 60,000 and credit your share premium 30,000. Now that's important that you understand how those rights issues are accounted for. And you can see here, there's very practical. Greencore would have done it in about 2015, 2016. Bank of Ireland, when they were in trouble in 2010, 2011, they had a big rights issue as well. So rights issues are quite popular for listed companies, where they're trying to raise not debt, they're trying to raise equity capital. And the first protocol is ask existing shareholders, because you technically have to ask existing shareholders, do they want to pay for new shares before you ask anyone else. So this is you're giving them a right to buy new shares, and typically at a discount to incentivize them to get involved in the deal. So disclosure requirements are pretty straightforward. You disclose in the face of the financial statements the issued share capital and reserves. We see those always, but sometimes if there's too many, you might pay it by the way of a note. So if you have too many reserve items, and you'll see those in the likes of Glanbia and CRH, Kerry Group's annual reports, sometimes they have too many reserve equity items, so they just leave it as a note to make it easier to break it out. And then the number of shares, the number of issued shares, etc., all of those have to be given by the way of a note as well. So you've seen all of that in terms of statement of changes in equity as well. So if we just look at one, for example, Glanbia, we look at the statement of changes in equity. So we look at the balance sheet first. Balance sheet tells us the issued share capital. See it there? Issued share capital gives us a note, 23, and other reserves. So they don't break out the reserves here. They say have a look at 24, and you'll go into more detail. So, but it's issued share capital that's given there. And then we'll come to note 23, which is on page 171. And you'll see the share capital, ordinary shares, and share premium. And they give you an example there. So they tell you here in the group the number of shares issued, 296,000. And the total number of authorized shares is 350 million. Right? So that's 296 million shares, because that's in thousands. Whereas the authorized shares are 350 million. So it just gives you an idea. They tell you the authorized share capital, and that's the issued share capital. And they have a share premium account as well. And then down in note 24, they give you all the reserves. Capital reserve, mergers, share-based payment reserve, all of these things that you'll cover in a lot more detail from next year onwards. So don't worry too much about these, other than know all of this has to be disclosed based on particularly IS1. We're just trying to show you the different disclosures you'll come across. And a lot of this stuff you'll cover next year in your final year accounting module. Right. So the next section we want to look at is a small section more on company law than anything, distributable profits. And we're trying to look at what are the rules around how much can you give back to shareholders. Right. So the main concern here is if you overpay dividends, and we've kind of seen this in semester 1, you will erode the capacity of the business. And particularly what's worrying for creditors is you will withdraw excess dividends and you won't be able to pay the creditors, either the bank, the taxman, the trade payables. So the whole principle here is capital maintenance. Are you keeping enough capital in the business to protect the creditor's interests? And how we do that is we abide by company law. They define what is distributable reserves, i.e. what can you give back to shareholders, and that's the only amount of money you can give back. So that's an important distinction to make sure the business is not paying out excess dividends and creating a risk that the creditors will not get their money back. So it relates to distributions to members, not just cash, but you could distribute assets, etc. And the ones that are exempt then is issue of bonus shares, because that's actually nothing to do, there's no cash leaving the business there. Redemption of preference shares or distribution of assets and a winding up. So they're exemptions that don't follow these rules, but everything else like normal dividends do. So a company must not make a distribution except out of profits available for that purpose. What you're saying here is you can only make a dividend out of distributable profits. And they are calculated as accumulated realized profits less accumulated realized losses. So the key two words there are accumulated, which means you don't just look at this year, you have to accumulate up every year. So if you're bringing a loss forward from last year, you have to accumulate that up. So just because you make a profit this year doesn't mean on a total basis you have enough profits. So you accumulate them up year on year. And realized means, as we'll have seen in some of the questions, this must be a realized profit. So if you make a revaluation gain or a fair value gain in investment property, they're not realized. They're only what we call paper gains because you haven't actually sold the asset on and realized that gain, turning it into cash. So there's important distinctions there that will link to a lot of the accounting standards we've covered to date. So accumulated realized profits, they are allowed so far as they're not previously used by way of distribution. So any profits you've realized in the past you can distribute unless you've previously distributed them or you've capitalized them, which means you've turned them into share capital. And that means they're not available anymore. Less accumulated realized losses. So far as they haven't been previously written off by way of a reduction of capital. Again, that's very niche. Don't worry too much about it. But particularly accumulated realized losses. If you make a loss, that will reduce your distributable profit. What they mean by this, accounting periods treat as continuous, they're saying you have to look at all the accounting periods together. So you might have made a 10,000 profit this year. But if you had a losses coming forward in retained earnings of 20,000, that means that 10,000 profit this year is eaten up. So it's not a distributable profit because you have to look at retained earnings. Retained meaning accumulated up every year since the start of the business. So we don't look at separate periods by periods for this. We treat the whole accounting period as continuous from the start of the business to the very most recent reporting date. Because otherwise you'll end up distributing profits in a profitable year and then having huge losses in other years which are ignored in future periods, which doesn't make sense. So unrealized profits are not available. Now they don't give a definition, but in general what we're looking at is a profit is realized when it's passed out of the company's control. So for example, an asset like property, plant and equipment or an investment property has been sold on and you've got cash in. So you've actually realized that gain and you've sold it. So examples here, a surplus on the revaluation of non-current assets in IAS 16 that is unrealized. Right? So in most instances it is unrealized. However, there is one situation where it isn't. If that surplus, for example, is a second time revaluation. So think about the nuance to IAS 16. It will be realized if the first time revaluation was down and you put that to the P&L. We know if we have a second revaluation that's up, we can put that revaluation gain to reverse the amount we put to the P&L. And that means you will realize some of that to reverse the previous loss. So that's the only situation where a revaluation surplus can be realized is when you're reversing a previous reval downwards. In all other cases, if it's in the revaluation surplus, that is an unrealized gain. That's why we distinguish it. So that's why one of the main reasons revaluation gains go through OCI and they don't go through retained earnings because they're unrealized. Anything in retained earnings usually is distributable, whereas this revaluation reserve is not distributable until it is sold on. So when the asset is sold, you take it out of reval surplus and you put it into retained earnings, which means you're then allowed to distribute it because the asset is passed out of your control and you got cash in. The other little thing to remember, we covered in IAS 16, is you can charge the difference in depreciation. You can transfer it from the reval surplus to retained earnings each year. So that means a portion of the reval surplus goes from being unrealized to being realized each year. So that's why it's important that some companies will take that option, is you're increasing your distributable profits each year by accounting for the difference in depreciation. So that's where some of the unrealized revaluation surplus can transform into being realized. So it's quite nuanced, but just have a broader appreciation. There's actually detailed rules here. Because think about it, it doesn't make sense to allow a company to distribute unrealized gains on property, plant and equipment revaluation because it's a paper gain. That gain could go to a loss next year. You haven't actually realized it until you sell it on. So otherwise what could happen is, in a gain, a company could pay it out as a dividend, but then when you come back for next year, the money has gone out of the business. And if the value of the property goes down, you could end up having a company with negative equity, which is a very tricky position to be in, particularly if banks are looking for money back as well. So this is trying to be conservative and manage the capital base of the business. So take a little example here. For this company, Alpha, it's a private company, profit for the year 200,000. Included in that is a fair value increase in investment property. So they must be using the fair value model under IAS 40 of 50,000. So just for this single year then, so we're kind of simplifying it, what are the distributable profits? Well, we know IAS 40 fair value gain, that's an unrealized gain. If you haven't sold the investment property on, you've just revalued it at the end of the year. So the answer there, the distributable profits would be 150,000. The full profit for the year, but we know within that is 50,000 relating to fair value gains, which are not distributable because they're not realized. So your answer there, just for that single year, would be 150,000. There is special rules when you're dealing with a public company that, in addition to the general rule, you can only distribute distributable reserves. There's another rule, they can only make a distribution if the amount of its net assets, which is assets less liabilities, is greater than the aggregate of called up share capital and undistributable reserves. So what they mean by that is you have to value the net assets and then you have to compare that to share capital and any other undistributable reserves. Now, undistributable reserves would be, as we've seen in the next page, share capital, share premium, could be revaluation reserve would be in there, capital redemption reserve, which we'll talk about in a second. So there's a special rule there. So just have the back of your head, am I told this is a private company or am I told it's a public company? If it's a public company, you have an extra thing to think about. You have to reduce it by any net unrealized losses. So it's a bit more conservative when you're a PLC, but again, don't get too bogged down. It's quite a small area. Just have the high level principle that PLC have a special rule which private limited companies do not. So the last main thing we want to talk about is, well, what happens if you redeem your own shares? So particularly if you have preference shares, for example, you can have redeemable preference shares. But if you redeem those, you could end up reducing the capital base of the business, which means it can increase the risk that the creditors will not have enough money to get paid. So in the Companies Act, in the company law, we have special rules around how you redeem company shares and how you account for them. Right? The whole logic here is capital maintenance. And you create this thing called a CRR, a capital redemption reserve. So that would be a non-distributable reserve. Same as share premium, means you cannot use that to pay dividends. It's non-distributable. And if you want to underline the key element here, it's to protect the interest of creditors. And I'm going to show you a nice little simple example in a second to illustrate why that is. So if you redeem your shares and cancel them, it'll go to a CRR. If you redeem your shares but you don't cancel them, meaning the company essentially holds shares in itself, they're called treasury shares. They don't have any benefits because they have no voting rights, and you can only have 10% of your share capital as treasury shares. And the main reason you might do that instead of cancelling them is you might want to reissue them at a later date. So there is some benefit in holding treasury shares, but a lot of the time they'll be redeem them, which means they'll buy the shares back off of whoever they gave them initially with the company funds, and they'll cancel them, meaning they're no longer issued. But if you do that, you have to create this CRR. And how you do it is, whatever the nominal value of the shares redeemed, you take that out of retained earnings, which means it's no longer distributable, and you put it into the CRR. You put it into the capital redemption reserve. And the CRR cannot be used for anything. It can only be used for a bonus issue. So it's a non-distributable reserve, and it's there to protect the interests of the creditors. And the creditors in this instance will be the bank, the trade payables, the taxman, and even the employees. So it's an important one, but we'll see what the best illustrated by an example. Why do we need this? Why can't we just pay it out of normal retained earnings and go ahead after that? So let's look at this small example. This is the last thing we'll do in this section. Before the redemption of its preference shares, you see its redeemable preference shares there of 20,000. The company had the following balance sheet. So it had capital, equity capital of 85,000. And your trade payables, your creditors, were owed 25. So again, from the trade payables perspective, there's very little risk here. You're not getting your money back. There's a huge amount of capital there. You have 110 of assets, and you're first in line to get the next 25. What we want to see is, what would the balance sheet look like then if we redeemed the shares? So we paid this 20,000 back, and no transfer went to the capital reserve, redemption reserve fund. So what would happen? So if we redeemed our shares and no transfer to the CRR, you would credit bank, right, 20,000, because you're paying money out, and you will debit preference shares 20,000. That's what's going to happen. So the entry there would be credit bank 20, going from 50 down to 30, and redeemable preference shares are now removed. So you only have equity capital left of 65. So that's what would happen. But look at the problem now. The next thing what happens is, what happens if these retained earnings are now paid out as dividends? Well, if they're paid out as dividends, now you've gone from a situation where the trade payable had 85 equity capital in the business as a buffer. There's now only 40. So the capital of the business has been significantly changed because there's been no capital redemption reserve to save it. You've gone from a capital position where there was 85,000 in equity capital, which is kind of like the buffer, because they get wiped out before the creditors get wiped out, to a situation where now that there's been too much dividends paid out, now there's only 40 left. So that really means there's been excess money paid out, and that means any payables, and if there was a bank loan, there's less chance of them getting their money back. And really, that's not protecting the interests of the creditors. So what would happen then if we transfer to a capital redemption reserve? Well, the first entry will still be the same. You will credit your bank 20, debit preference shares 20. Right? But what happens then is you take the 20 of the preference shares and you take it out of retained earnings. So you will debit retained earnings 20, bring it from 20 down to 5, and you will credit a new capital redemption reserve of 20. So what happens here now is we say you cannot pay that 20,000 out as distributed profits. Because remember, as a preference share, that 20 was always non-distributable. So that means it can never have been distributed out. So you want to maintain non-distributable reserves here of 60,000. We didn't do that when it came here. It only went to 40. So that meant the shareholder could get rid of the full 25, leaving them with 40. So what they do here is they say that 20 that was previously preference shares is now going to be created a capital redemption reserve, and you're not going to be able to distribute that. Because when these trade payables gave money into the business, these creditors, there was 60,000 of share capital there. Between ordinary shares and preference shares, that 60,000 must remain. You maintain the capital. So that means the only dividend that can be paid out now is 5. which is the minimum of the equity capital will still be the 60, which is the same as the minimum share capital here, the 40 and the 20. This retained earnings was always distributable. The only thing you're changing now is to say that 20, when it was redeemed, it doesn't transfer into retained earnings. It is taken out and it's left in a thing called capital redemption reserve. And that's the most you need to know. And the main reason we're doing that is to preserve the 60,000 of equity capital. If we don't, what will end up happening is too much dividends are paid out and you're left with a lower capital than you started with. And that is not capital maintenance. That is eroding the operating capacity of the business, and it's putting into jeopardy the ability of the creditors to get their money back. And if that happens, no bank or no trade payable will lend the company money. They need those protections under company law, and that's how they're given them, by creating a capital redemption reserve. And if you look in Glanbia, there's your capital reserve. So they have a capital redemption reserve. Now, nothing happened in the last couple of years, but you can see 2.8 million was there. Reserve comprised a capital redemption reserve and a capital reserve from the renominalization of share capital. But that's the main one. This does happen in the real world. Now, it didn't move for the last 2 years because something happened in previous years, but these do happen in the real world. When you purchase your own shares, it'll go in there. Just nothing has happened in the last year. That's why there's no entry. So these are real important things, and they link significantly to company law as well. So have a look at Connolly chapter 18. It's not vital. If you have the textbook, that's fine. If you don't, it's not the end of the world. You have enough material there to look at. And have a look at question pack 14 and some of the tutorial questions, which will embed some of this knowledge into it as well. All right, so that was looking at share capital and distributable reserves.